Quantum Cosmos presents Certified Financial Guardian, a seal of ethical selling. We have with us Chirag Mehta. Chirag is a senior fund manager at Quantum Mutual Fund. He specializes in the field of alternative investment strategies with 11 years of experience handling commodities. He is the fund manager of Quantum Gold ETF, Quantum Gold Fund, and Quantum Equity Fund of Fund, and also the co-fund manager of Quantum Multi-Asset Fund. Chirag has to his credit an MMS in finance and a chartered alternative investment analyst to his credit. Chirag also has been a part of Quantum's multiple Path to Profit events held in various cities where he shares his insights on views on gold, and he writes his column, The Golden Truth. Chirag, thanks for joining. Can gold make money when we are slowly sleepwalking into a recession? Paul Krugman recently said that we are heading into a kind of recession which may not be of the same magnitude of what happened in 2008. Although there's a period of risk on, we cannot ignore the risk involved. Sure. What's your view on that?
Absolutely. There is a lot of uncertainty in the global world right now. If you see, we are clearly moving towards a slowdown across the globe, be it US or Europe or Japan or any other country in the world. We are moving towards a slowdown. It's a given, right? Plus, there are a lot of issues like trade tensions, political issues in Europe. You have Brexit looming large, and you have geopolitical crisis in a way which is unfolding in various parts of the globe.
Correct.
So all these uncertainties call for having an allocation to gold, because time and again gold has been useful during such crisis. So far we have seen world being aided by central bank interventions in terms of money printing or lower interest rates, but they had been unfolding that over the last couple of years, and it's just been 1 year of real tightening. They had to abandon it, right? So in a way, it's clear that the financial world that we live in is dependent on stimulus or artificial support, and that is why it cannot last for longer, right? And if there is a crisis that strikes, then I think gold is one that's going to be chased after. So if we are moving towards a recession, which is very likely, if you see the yield curves or various other indicators, it's all pointing towards that we are heading towards that direction. Magnitude of that will depend on what central banks do, but if central banks act like the way they did in 2008, it's going to be even more positive for gold.
Right. So the US economy has done fairly well, but despite that, the Federal Reserve is going slow on hiking interest rates there. So the greenback has done fairly well. I mean, it's been pretty resilient. Do you think gold will be looked up to a reserve currency?
So dollar had two pillars of strength. One was Fed, which was a lone central bank hiking rates, unwinding its balance sheet, whereas others were just not hiking rates, but they were also not unwinding their balance sheets the way the Fed was doing. So that lent tremendous strength to the dollar, because other guys were much behind than where the Fed was.
Correct.
Right? That was one pillar of strength. Another pillar of strength for the dollar was equity markets in the US. It was like getting significant flows, and much of the buoyancy in equity markets in the US was on account of share buybacks. If you see, there have been significant buybacks in US shares over the last few years, ranging from $500 to $800 billion a year, and that was leading to strength in earnings in the companies in the US, and therefore the strength in the. Now we are seeing those two pillars going off in a way, right? Fed has abandoned rate hikes. They've stopped unwinding the balance sheet, so that is gone. Another thing is share buybacks. If the liquidity dries up, right? If the Fed is not adding more money in the system, there's less liquidity and less scope for buybacks, right? So those trends that we were seeing for the dollar are coming off, and that is why it could come under pressure if there is a recession in the US. So that will drive how the dollar behaves going forward, but increasingly it should come under pressure.
But gold has moved fairly flat over several years now.
Yeah.
In 2018, it generated a return of about 1% negative. Last 5 years, gold ETFs have generated 1.8%. So you think that investors should be really investing in gold now?
So we had a trend of money moving to risk assets largely, and that was driving money away from gold. And since risk assets were a one-way street, everyone thought we don't need gold in this kind of scenario. Right? But things are fast changing, and every asset will go through a cycle. Right? If you were to ask anyone in 2013, would you invest in equities? The answer would be no, right? Because 5 years in a row, equities didn't move much, right? So is the gold right now. So every asset has a cycle, and I think it was a down cycle for gold that we were seeing, and I think the conditions or factors are getting in place for the cycle to turn. So I think gold's going to do well going forward. Maybe if not by end of this year or maybe into next year, we'll see much higher gold prices.
So will Bitcoins replace gold?
I don't think so. Bitcoin, again, if you see, no one knows really what's backing Bitcoins, right? What is what is the intrinsic value of a Bitcoin? If you see, gold is a monetary asset. It has been used as money for several years, right? For thousands of years, it has acted as money until 1971 when US took it off from the gold standard. Right. So it has a historic value. Even if you see central banks today hold a lot of gold as reserves. So that really lends credence to gold to act as a monetary asset, so and it is a monetary asset.
Your views differ a little bit from venture capitalist Lo Kerner. He said that speaking to CNN, that Bitcoins is well on its way to replacing gold. You don't think that's happening?
Absolutely not.
Okay.
Not in our lifetimes.
Right. Coming to India, gold in rupee terms, as we discussed, has generated negative returns. The returns in 2018 were 7%, but if we see the long trend, it's about 1.5%, 1.8% or so negative. What are the key factors which have worked in favor of gold in India, and how do you see the Indo-Pak tensions, the Iran-Iraq war, the overall geopolitical scenario affecting gold prices here in India in context to the weak rupee?
Yeah. So when we are talking about returns, we are looking at like 3-year, 5-year kind of returns. But if you go longer than that, like 10, 15 years, gold has not done so badly for an Indian investor, right? Returns will range from somewhere around 7% to 10% kind of ranges, depending on time period you pick and choose. So it has not done that bad. It's just the recency that remains in our mind, and we just look at those returns and say it's a bad investment. But if you see much longer time periods, it's not done that bad.
So you're saying that the secular uptrend for gold is intact?
So I said every asset will go through cycles. Gold didn't have a good cycle in terms of because money was flowing to risk assets, and that is why there was not much money flowing to gold, and that is why we saw the correction that we saw. And before that, we had a big run up in gold prices, if you see. A few years, like in 2004, prices were around 4,000, 5,000 rupees per 10 grams. And it went to 34,000 rupees per 10 grams. There was significant up move that we saw. And no asset can keep rising in a straight line, right? Every asset will have its cycles to play.
So in Indian context, what are the factors that will play out well for gold?
So in the Indian context, we don't have an Indian price. Gold price is set internationally, and what we do is take the international gold prices, multiply by the rupee rate, and add taxes. So in the Indian context, it's largely the rupee and the taxes that add to the gold price. And the rupee, if you see, can move because of the factors that you said. It could be like if there is no stable government that we see, then rupee may go for a toss, right? In such cases, it will help gold prices in Indian rupee terms, and it will go up to that extent rupee depreciates. So it all boils down to what happens, what factors impact the rupee, and that will impact the Indian gold price.
Do you think demonetization and GST affected gold prices? The demand went down, and how do you see that?
So if you see during demonetization, there was a lot of demand immediately after demonetization
all the
happened.
Black money was rushing to buy gold.
I don't know what kind of money, but demand was there absolutely in gold markets, right? And post that there was a lull, and we saw more like in compulsive buying. Like India, if you see, there are two kinds of buying that happen. One is a compulsive buying related to the marriages, festivals, gifting purposes, and other is purely from investment mindset. So investment money wasn't flowing to gold. That is why we dropped from 900,000 tons of demand a year to 600, 700 tons of demand a year, which is more related to a compulsive kind of buying for marriages, for consumption, and for festivals. Right? So that investment demand dried up, and that got knocked off. So once people in India are largely a return chasing mindset, right? If the asset does well, they will flock to that asset class. So if gold gives good returns for a year or two, I'm sure those investors will come back, and we'll see investment demand catch up, and again the demand will go to 900,000 tons in a year. So that is how it functions in India.
Correct. So Indians have the affinity to gold. The investment demand comes from mainly, in our case, gold ETFs, gold funds, and so on. But people in India have been buying gold in a physical form. Gold bars, coins, jewelry, etc. When will this change, and when will people really look at gold in a more serious way as an investment alternative?
I agree. There is a very thin line. Though people are buying for investment purposes, still they buy it in a jewelry form because that's tradition. Not only tradition, because some years back you weren't allowed to buy any other form. It was only jewelry that was permitted. Right? Then they introduced gold bars and coins, and then investment products like gold funds. Right? So slowly people are warming up to that idea, and they need to be aware because Indians are very price conscious. So if they become aware that this is a better form and a very price efficient form of buying gold, I'm sure they'll slowly move toward this and open up to the idea of buying gold funds or gold ETFs. So I think it's just a matter of next demand wave come in gold, more from investment perspective, and an awareness from the gold funds or gold industry that this is surely an efficient form of buying gold, because it is a biggest innovation that we have seen in years, because it allows a retail investor buying half a gram of gold at prices where tons and tons of gold get exchanged between a producer of gold or miner of gold with a bullion bank. So that's the efficiency that gold ETFs bring to the table. And once people know that they don't have to pay high margins, high premiums, high making charges for buying gold, I'm sure they're going to come for the gold ETFs.
Right. So you are convincing your investors to invest in gold ETFs.
Sure.
All right. Okay. Since inception, returns of gold funds reveal that it has underperformed the prices of gold by about 80 basis points compounded. What are the reasons for this?
In general, also, investors will have to note this, that every gold ETF or every ETF have to underperform the index it tracks. Right? Because there is an expense to run the scheme. And there is a tracking error which usually is very, very low. For example, for the quantum gold ETF, it is 0.005% since inception on an absolute basis. So the tracking error is very, very low. We just try to stay invested in gold at all points of time. We do not take a call on gold prices and see to it that your returns are in line with gold. So largely at 80 basis points reflects the expenses and the tracking error towards that fund.
Okay. Moving away from gold, you also manage a quantum equity fund of fund. Can you explain a little bit more on about that scheme? How is it different from the other diversified equity schemes in the market?
So the quantum equity fund of funds, as the name suggests, is a fund that invests in other equity funds. Right? It's the only equity fund of funds in the country. It allows investors to invest in 5 to 10 diversified equity funds which are consistent across time frames, which go through a qualitative and quantitative process where we select funds, and it's the fund manager picking up other fund managers. So we don't invest in a fund without meeting the fund manager. Right? And it's not just the sake for namesake we meet. We ask very tough questions for the fund manager to answer and satisfy us that they have a process for investment, and they abide by the process at all times. Right? So it is a very methodical way of selecting funds. It uses various qualitative criterias which go into selecting those managers, and a meeting to satisfy us that they are really the really guys worthy of investments, and on behalf of investors we invest in that fund.
How has been the track record?
The track record has been pretty good. The long-term track record is above the index it tracks. It doesn't track an index, but it's above the benchmark that is BSE 200 for that fund. So it has outperformed that benchmark over long time periods, it doesn't have a huge churn in that. So we have been able to pick consistent managers in that fund. And we think the track record has been pretty good for any investor to consider. And the most important part is we try to avoid risk involved in selecting funds. It could be wrong fund house, wrong fund manager. There are 550 equity schemes in the country, which one to pick. So we make it more convenient for investors. Try to see that the risk is minimized for that investor of picking the wrong fund. And over long time periods, we try to generate a moderate or a good enough track record for that fund or for that investor. And it's just one scheme they have to track, monitor, and one investment they have to make, right?
Correct.
It's just one investment. They get exposure to 7 equity schemes across market caps, and their equity needs are being sorted. So it's just a one-stop solution for equity needs of any investor.
Right. I think all fund managers at some point in time make mistakes and they regret about it. So what are the mistakes you made, and how did you learn from those mistakes, and how do you plan to implement going forward?
If you see throughout my history as a fund manager, the share of mistakes have been much lesser as compared to the share of the positive ones. So any mistake, if we do, we try to rectify and see to it, implement or imbibe that issue in our process. So that we don't repeat that ever again. So it's very important to learn from that mistake and put it in the process, so that even if I'm not the fund manager going forward, that repeat will, absolutely. So we are a process-driven fund house. Every investment or every fund that we have runs through a process and a team-based approach. And once any mistake or any learning gets imbibed into the process, it doesn't repeat itself.
Okay. My last question. 3 books which you would recommend to investors and advisors on gold, on equity investing, whatever you like.
Yeah, so in terms of books on gold, there are plenty out there. Each one has its own unique messages that it gives. But I would recommend people or investors read Hard Money by Shane Maguire and Asset of Money by Niall Ferguson. Those are 2 excellent books that one could give. It gives good history of how money has evolved over a period of time and how gold has been a true form of money.
Correct. And I think these are very valuable reads for the entire IFA fraternity when they are managing people's money as custodians of people's wealth and handling and advising advisors. I'm sure they will benefit from these recommended readings. All right, Chirag, thank you so much for your valuable time and valuable insight.
Thank you so much.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.